Investing in turbulent times may be anxiety-inducing for some investors, but for others, it may spell opportunity. What are the key risks that investors should look out for, and what part will inflation play in all of this? We talked to HSBC's Chief Investment Officer, Southeast Asia for Global Private Banking and Wealth, James Cheo, about how to rejig portfolios in an uncertain market. As this undercurrent of uncertainty continues to cloud the global market, what do you think are the key risks that Malaysian investors should keep an eye on?
Well, we are braving a new world of macro uncertainty. Well, the confluence of pandemic, conflict, as well as what we have with climate change has caused energy shortages, food shortages, and that's created quite a lot of inflationary pressures as a result. And because of that, central banks have to increase interest rates. And by doing so, it actually slows down economic growth. And from that perspective, of course, inflation is a big risk. And that's something that investors in Malaysia should watch out for. While there are early signs that inflation is starting to peak, especially on the headline side of things, but I think it's still early days because in many ways, inflation is still very much sticky, especially when you look at service inflation. With wages, with rentals, these are still very high, especially in the United States. So I think from that perspective, there's going to be a lot of uncertainty associated with what US central banks or even global central banks will do in terms of the interest rate trajectory. And of course, in this environment, it's going to be uncertain. Growth is going to be fairly slow, and therefore, investors have to watch out for the earnings of corporations. And I think that's going to be another marker that investors have to watch out in the weeks and months ahead.
What is your advice then to investors to weather these, uncertain, volatile peaks? Is there a sort of one-size-fits-all advice that at least some people can follow, like a guideline?
Well, I think there is going to be a need for a paradigm shift. In the past, since the financial crisis in 2008, the playbook was very simple for central banks. Whenever there is any growth scares, central banks would ease monetary policy, cut interest rates, introduce liquidity through quantitative easing.
Yes.
But I think that economic environment that allowed that sort of game plan has changed. Primarily now there is inflation. And of course, central banks cannot cut interest rates. They have to increase interest rates. They cannot continue with the easy monetary policy. So at that time, since the financial crisis, what we've seen is that because of the easy money of sorts, we have seen financial markets kind of increase. Both bonds and equities have done very well. So it was almost like a rising tide that lifted up all boats. So this time round, my suspicion is that it's no longer going to be a rising tide that's going to lift up all boats. The waves are probably shorter, economic cycles are going to be a bit more uncertain, and there will be boats that will do much better than others. So I think in such an environment that equity bond portfolio, where the 60-40 that used to work well in the past might not work so well now, and there's a need to change strategy. You have to think about adding alternative assets into the mix. Alternative assets includes real assets like private real estate, for example, like commodities. And also you have to think about some of safe haven assets that could actually do well in such an uncertain environment. I think from that perspective, there is really a need for this paradigm shift to add alternatives into investment strategy in the years ahead.
Going back to what we were talking to earlier, and I think this bears repeating again about how inflation has become such a hot button topic, right? It's one of the main concerns for the middle class. We were talking about climate change. Is investing even more crucial at this point of time when we are worried about inflation? Or should investors wait for the situation to calm down a little?
For most people, inflation would also mean that for, let's say, 1,000 ringgit, the amount of goods because of inflation that they can buy has reduced significantly. Yes, it's shrunk. But what people don't see is that it has an effect on savings as well. In a way, your savings is worth less. In a way, if there's an inflation that's sustained and high, whatever deposit rate that you get, it erodes that savings that you have. And if you hold cash over the long run in a period of high sustained inflation, it actually erodes your cash position. So I think you have to think of ways in which you have to invest this savings so that you could beat inflation. And I think that there must be a right strategy in terms of asset allocation. There must be a right way in terms of selecting companies that can benefit in periods of higher inflation.
For those who do choose to invest, and we were mentioning alternative assets, right? Where is a good place to park your funds in these uncertain times? Is it what's the proportion of alternative assets to safe haven? Is there a magical ratio?
Well, there is no one-size-fits-all for everyone, but clearly I think you have to have a globally diversified portfolio in global equities, global bonds, as well as alternative investments that includes commodities, private real estate. That actually does well in times of higher inflation. And especially when you look at security selection for that global, whether it's bonds or equity portfolio, you want to look for quality companies that can actually increase price amidst higher input costs.
Right.
So you want to find those companies that can maintain their profit margins and also can gain competitive position in their industry during such time. And I think these are broad strokes on how one can invest in a period of higher and uncertain price pressures.
Does rising inflation affect the quality of investment assets overall? We talked about how it looked on cash. Certain companies, you can definitely see how inflation affects them. But is it a broad stroke? Does it affect all investment assets, inflation? Is it a main concern for them?
One impact that has a secondary kind of feedback loop is that in a period of higher inflation, central banks will have to increase interest rates.
Right.
And interest rates is primarily the price of money. And of course, in financial markets, every asset is actually a kind of a future cash flow kind of discounted by interest rates to a present value.
Yes.
So in a period of higher interest rates, what you get is a repricing of most financial assets, whether it's bonds or equities, because all these are all cash flows, future cash flows, discounted by the interest rate to the present value. And that's why we are seeing quite a lot of uncertainty and volatility for financial market assets this time around because of the repricing of interest rates that's going higher. And I think from that perspective, how investors can kind of navigate, again, is that you want to select companies that have quality criteria, not just the ability of them being able to raise price to protect their margin, but you also want to look at companies that has low debt levels, because in times of higher interest rates, the debt burden can increase for companies that are highly geared in that sense.
Yeah, it'll hurt even more for them, won't it? Yeah, and it'll be harder to do the repayments as time goes on. Because it's going to go up, for sure, right?
Yes, absolutely. So that's where I think you have to be much more selective when it comes to selecting companies, not just on the profit side. You have to look at their balance sheet as well. So I think in such an environment, it's very crucial to get the selection of securities right.
Let's say worst case scenario. Let me play devil's advocate with you. There is a recession. Many are saying it's inevitable, no matter what governments are trying to do in terms of their messaging. This means there's a lot more black swan events. There'll be a lot more uncertainty. What does this mean for the medium to long-term investor?
Recessions are part of a business cycle. There's a period of recovery, there's a period of slowing growth, and there's also periods of recession. So it's a very normal part of the business cycle. What's important for investors is not so much trying to predict what we're going to get, but more to prepare. Really, by preparing, what it is to set up a kind of a diversified portfolio of global equities, global bonds, alternative assets, and let that that portfolio rise and increase over time. And I think that's very, very important, especially amidst inflation. If you hold mostly cash, it gets eroded. And therefore, I think it's very important that investors try not to time the market, but have time in the market with a diversified portfolio.
Aside from inflation, what are the other big sort of speed bumps that you think investors should keep an eye on? Maybe not necessarily panic about, but keep an eye on.
Inflation is the key risk, but of course, right now, I think that risk could shift towards growth concerns because central banks are increasing interest rates, and that's really pressing the economic brake. And in that sense, it could slow down the world economy. And I think that's where I think investors have to start to look out for that as a risk.
Everybody has a very different kind of investing style. But I think a lot of people want to know, where do you go for advice? It's like, is it online, or do you think you should get professional help in this kind of case?
Yeah.
No matter how big your asset or portfolio.
Well, I think it's always helpful to go for a professional to help you out, really, because it takes away the emotion when it comes to investing. Because what we have noticed is that if most people, when they invest, they tend to be very attached to that decision. They typically like a particular company too much. And when things don't go well, they don't sell out, they hold it for too long.
Yeah.
So there isn't a kind of a disciplined way. And that's why I think it's important to have a professional investment advisor to help you set the asset allocation right. And when kind of market conditions change, do the rebalancing, select the stocks based on very quantifiable factors. And I think those things will go a long way to helping investors get a kind of a reliable return over the long haul.